Welcome to the BlockCrunch Podcast, the show for crypto natives. Every week, we do short but in-depth conversations with the most important builders and investors in crypto, so you can filter through what's noise and stay ahead of the markets. I'm your host, Jason Choi. Nothing on this show should be construed as financial advice, and my guests, myself, and my employer may hold positions in assets discussed on the show. This episode is brought to you by Crypto.com and Aave. Stick around to learn more. Now, if you've been around crypto for a while, you've probably heard of the project Bancor. They are a project that raised over $150 million back in the ICO heydays in 2017 and 2018. However, a lot of people would probably say that they haven't really lived up to their ambitions, especially relative to other competitive products like Uniswap or even newcomers like Sushiswap. However, something very interesting started to happen at Bancor since the beginning of this year. Ever since they launched their version 2, which seeks to revamp core parts of the decentralized exchange and promises to solve one of the largest challenges facing DEXs like Uniswap, they have seen their trading volume skyrocket and their market share began to climb slowly but surely. So to figure out why users are seemingly rediscovering Bancor, I'm excited to have Mark and Nate from the Bancor team to break down just what V2 is all about. And for the more technical amongst you, we do get really deep into how the token model works and how they intend to solve the challenge of impermanent loss. And if you stick around to the end of the episode, we even talk about the trade-offs that they are making to achieve this. So is Bancor the endgame for decentralized exchanges? Will Bancor overtake Uniswap? These are the questions that we'll try to answer for you today, and I can't wait to dive in. All right, I'm super excited to have both Nate and Mark from the Bancor team finally on the show. So guys, welcome.
Thanks so much. Yeah, appreciate it.
Just to give some context here, Bancor is a project that's been actually around for a while, one of the oldest projects in DeFi, and you guys raised a whopping $150 million back in the 2017 days, and the team seems to have gone a little quiet for a while, but recently it hit the market by surprise by almost 5xing its market share relative to some of the major players in the span of 3 months. And this really caught the attention of a lot of people, especially after the launch of its V2. So for listeners who are not aware, can you help us understand briefly the history of Bancor since the initial days and what happened recently to drive this phenomenal growth?
Yeah, sure. I can take that. I've been with the project since early 2018. Bancor was the first automated market maker on Ethereum and on the blockchain, as far as we know. We launched in late 2017, and it's been quite a few interesting years. As you said, it did take some time for the AMM concept to really start to click in the crypto world. Uniswap launched probably in late 2018. Now, by that time, Bancor had about $1 billion in trade volume, and most people knew it kind of as a DEX to trade against. And really, over the years, people started to adopt the action of providing liquidity to decentralized liquidity pools. And really, what Uniswap came in and did is they pretty much forked the idea of Bancor and AMMs and replaced BNT with ETH in its pools. As we know, Uniswap V2 came out and allowed any tokens to be paired together. But really, the key decision that Uniswap made in the design model was to remove the protocol token from the pairs. And really, I think the kind of key reason why Bancor seemingly sort of went quiet in the crypto community is because having the protocol token in our liquidity pools really was sort of a barrier for adoption for liquidity providers to provide liquidity. In V1 of Bancor, you had to provide liquidity with the risk asset and BNT. What Uniswap did is you could provide liquidity with the risk asset and ETH. And most people have ETH in their wallet. It's just an easier token to provide liquidity with. But what we quickly discovered really early in the project and have been working on for a couple years now is this issue of impermanent loss. And that the idea that the AMM in its earliest phase has some sort of key issues. And so impermanent loss is one when the paired asset diverges in price from the risk asset. You end up selling off your risk asset, and you can be left, whereas your the liquidity that you have in there that you pull out can be worth less than what you actually put in, even when accounting for fees and any liquidity mining rewards. So that was this key issue that we identified early on, and also that when people are holding a token and they want to provide liquidity, they don't necessarily want to lose their long position or take on exposure to a sort of paired asset. And so what Bancor really came out with, and it was sort of late last year with V2.1, is a way to sort of remove the risk of impermanent loss for liquidity providers, and also to allow them to provide single-sided liquidity. So maintain their long position and 100% exposure to provide liquidity with just one token, as opposed to splitting it into ETH or whatever the paired asset is. And so since we came out with this V2.1 version with single-sided liquidity or single-sided exposure and impermanent loss protection, we've really seen things just go parabolic. The amount of liquidity, the amount of volume has really just something like 80x with respect to both. So it's been a really wild ride, especially just in the past few weeks. We've seen liquidity break a billion. I think we're now, it took us a couple months to get to a billion in locked liquidity, and now we're approaching 1.5 billion. And so the system, it's a little more complex. It's a little harder to understand. From the user's perspective, it's kind of quite easy and straightforward. But I think it took a little time for things to click, and now they are clicking, and we're really seeing an explosion in interest.
Yeah, thank you so much for that context. And it sounds like identifying the way to kind of counteract impermanent loss is really key here, which we'll definitely dive into because I know a lot of listeners are probably confused about impermanent loss and what they're actually standing to gain when they use Bancor versus something like Uniswap. But I'd like to kind of focus on the fundamentals here a little bit because, as you mentioned, Bancor is designed a little bit different from these newer AMM projects like Uniswap or even Sushiswap. So, can you walk us through how the pools are constructed and how they're different from a 50-50 pool in Uniswap? And perhaps the easiest way to do this is to examine from the side of a liquidity provider or even from a user.
Yeah, sure. Mark, do you want to take that?
Yeah, for sure. So, if you wanted to become a liquidity provider on for example, Uniswap, you need to provide liquidity with both of the tokens. So, for example, if you wanted to take let's say a $100 liquidity position, you need to provide $50 worth of your favorite token, whatever that happens to be, and then $50 of Ethereum. And so when you deposit those into the smart contracts, you're really still exposed to both of those assets. On Bancor, you have the option to just provide the one token that's close to your heart. And so you no longer need to own the BNT side of the pool. How we manage this is by setting a minting cap on each pool. So up to a certain threshold, the pool is allowed to mint the BNT required to fund the opposite side of the pool to match the user's deposit. And so this means that the protocol essentially co-invests with you. All of the fees that are generated are still split 50-50 between the BNT side and the token side. But the user who deposited the token side is not exposed to the volatility of BNT. And so because we offer impermanent loss insurance, it also means that the user is guaranteed to not lose any of the tokens that they provided. So on Uniswap, for example, if you're stuck in this sort of this paradox, because if you are bullish on a certain token, you're kind of hoping that its price is going to appreciate relative to Ethereum, right? That's your long position. But if you're providing liquidity with it, that's actually the opposite of what you want, because as its price starts to appreciate over Ethereum, the liquidity pool will actually start to sell it off to the market in the form of arbitrage opportunity. So Bancor helps to get around that situation by protecting the user from that impermanent loss and allowing them to stay long on that token without requiring them to buy BNT to fund the other side.
And I'd love to understand the trade-off of this single-sided provision a little bit better, because it sounds like, while for liquidity providers, if I provide one side of it and the price of that token that I have provided liquidity to does increase, I will have kind of full exposure to that appreciation in the price. But does that come at the expense of the BNT holders? Because it sounds like there will be new supply being minted out of nothing for Bancor tokens, right?
Yeah, absolutely right. And so the way that I've explained this previously is you have to think of it as a mutualized risk. So just like from all of the models that we have, it really looks like that if you've got a certain liquidity depth and you hit a certain volume target, that the profitability over all pools is more than enough to compensate for impermanent loss. And so this means that we've got built into our token management system a way to deflate BNT to counteract the inflation that's associated with specific impermanent loss compensation. So you got to think about it from the perspective of an insurance company, right? So if let's pretend you're offering fire insurance on houses. The reason why, as an insurance company, we can be confident in offering that insurance is because we've evaluated the risk profile for this event happening. And we know that if there's a certain number of people participating in the insurance policy, that we can afford to pay out all of the houses that actually burn down for people holding these policies. And for the people that are buying that insurance, they appreciate that even though there is a low likelihood that they're going to be, in a situation where they need to rebuild their house, they get the peace of mind that if it does happen, they don't need to worry because the insurance company is going to compensate them. So that's really the best way to think about the Bancor model, is that the assumption is that at a certain volume and a certain liquidity depth, the protocol overall will still be able to completely offset the inflation associated with impermanent loss payouts. And we haven't quite hit that target yet, but as you can see over the last couple of months, we're still in a rapid growth phase, and it really does look like we're going to be hitting our economic targets pretty soon.
And just to be clear, to add to that, so when Bancor, the protocol provides the other side of the pool, right, it is minting BNT. Let's say I come with 100K in Link. The protocol is minting 100,000 in BNT. Now, that BNT generally stays within that pool, earning fees for the protocol. This is protocol-owned BNT, and it is burned eventually in two instances. One, if the Link liquidity provider, whose 100K is associated with the protocol invested BNT, when they pull out of the pool and withdraw, the protocol's BNT associated with their stake is then burned, along with any fees that protocol invested BNT has generated. And another instance in which that protocol invested BNT would be burned is if a user comes to the pool and provides BNT or stakes BNT inside that pool, they are effectively taking over the protocol's position in the pool. And when they provide their BNT, then the protocol's invested BNT is burned. So the most common misconception is, if Bancor is turned into an elastic supply token and it's co-investing, isn't it just endlessly and infinitely minting BNT? And the answer is actually the BNT is co-invested into the pools, minted into the pools. It doesn't go into the open market, and it allows the protocol to earn fees in a pretty novel way and eventually burn that BNT. So you could think of the minted BNT actually in sort of three ways. One is the co-investment to support single-sided provisioning. The second is minted BNT that might need to be provided to cover impermanent loss. So that's impermanent loss compensation. And again, it's important to note with that minted BNT, it's only provided when the liquidity provider withdraws from the pool. So it's not like as the pool is suffering, say it suffers from impermanent loss, it's not like the protocol is minting BNT the entire time. It's only if the liquidity provider pulls out and the fees that have been generated from the protocol invested BNT are not enough to cover any impermanent loss that occurred, then the protocol would have to mint some BNT in order to cover the difference. And then the third potentially sort of inflationary or minting functionality is liquidity mining rewards, and that's similar to any liquidity mining reward system, except with some very interesting nuances, which we can get into, which actually prevent the minted BNT from mining rewards from ending up on the open market. So I know that was a lot there. So happy to kind of answer any questions or anything that's not clear on that.
Yeah, would love to definitely clarify that because it sounds like now when I deposit liquidity for, say, a link token into a pool, the Bancor protocol basically mints an equivalent value in BNT token to supply the liquidity so that people can trade against it. And that liquidity, that net increase in BNT supply is only removed when I pull out of the pool. Or if some other user provides BNT in that pool to displace the token. But is there any time is there any occasion in which there's actually a net reduction in the BNT supply? Because it sounds like right now there is a minting of new BNT to supply to these pools, and there's a reduction of that minting. But is there ever a net reduction in that mint?
Yeah. So the
Yes.
net. Oh, go
Sorry.
ahead, Mark.
Yeah, so it's a really well informed question. I think one of the ways that you can look at it is that when we launched V2.1, we had whatever the static supply of BNT was from its ICO era, right? Which I think was something like 69 million BNT, and so we can only ever contract back down to that level. As the as Nate was pointing out, with the fees that are accruing, right, in terms of swap fees associated with the protocol. Remember, these are being absorbed from outside. So the protocol's minted BNTs, it's not a fixed number; it grows, right? The same way that when you provide link, your link stake grows over time. So as as you withdraw your link stake and the BNT stake is burned, you are burning more BNTs than were minted.
Got it. And do you foresee the BNT supply ever entering a state of prolonged or perpetual contraction, or is this going to be more of a dynamic, kind of elastic supply situation?
It's definitely going to be a prolonged, dynamic, elastic situation, but that doesn't mean we're not going to enter phases of deflation. So we have to manage the token supply in in a way that kind of reacts to changing market conditions. So one of the mechanisms that we have in place to do that, right? One of the dials that we can control as a DAO in order to implement sustainable monetary policy has to do with the vortex, but I think maybe we should leave that for later on in the conversation because I'm sure you're going to want to talk about that as well.
But and before moving on to that, Jason, I just want to make sure you're sort of clear on this because it's really one of the most commonly overlooked things. The BNT that is minted by the protocol, you asked when there would be a net reduction, and that is when the fees that are generated by the protocol invested BNT. Again, remember when the protocol puts BNT in, those BNT are still generating fees. And so it is when the fees are greater than the impermanent loss suffered by the liquidity provider whose stake, let's say the Link LP, whose stake is associated with the protocol invested BNT. So you could think of an instance just like any liquidity pool in the industry. There's certain liquidity pools that are extremely profitable, and there's some that are extremely unprofitable and leave LPs completely wrecked. And so if you think about it on a sort of network-wide basis, what we've done is we've sort of diversified the risk of IL across many numbers of pools, such that there are certain pools that are hugely profitable for the protocol, and there are certain pools that are maybe less profitable for the protocol. But as a whole, when the fees are greater than the impermanent loss compensation that's paid out at the time of a LP withdrawing, that is when you see that net reduction and deflationary functionality in BNT. But is that clear that the protocol is generating fees from its invested BNT, and those fees are then burned to deflate the supply.
And these fees are generated from users trading in that pool, right?
Correct.
Got it. Yeah, I think that makes a lot of sense to me. And I guess a follow up question there is because it sounds like the core of this model really is to have BNT trade against all these different tokens across these different pools, which is obviously quite different from how Uniswap started, which is all assets trade against Ethereum or Sushi trade against Ethereum. Do you foresee only allowing trading against BNT in these pools as a bottleneck to growth, or is that, or are there plans to kind of open up these pools to pair up against ETH as well?
We certainly
Um,
won't. Oh,
go
you
ahead.
go ahead, mate.
Well, there's a couple ways to look at this question, and I'm happy to have uh, Mark jump in too. We think the bigger bottleneck to growth is that LPs are consistently having to give up their long position on their token and having to suffer impermanent loss. I think once token hold, there's this whole body and subgroup of liquidity providers that I think is untapped, and that is the token holders. I think Link has been so quick to adopt our solution because they really don't want to put any of their tokens on the line, right? They really think that their tokens are very precious to them. They don't want to lose them at all. And so all of a sudden, you're seeing this new type of liquidity provider who is very bullish on their tokens and don't want to see them shifted around into ETH or another token. So I think that it will potentially open up a whole new channel of liquidity. And in terms of constraints on growth in the system, the DAO is determining how much what the co-invested limit can be per pool in terms of BNT. So these pools are capped in terms of space, right? The protocol can only provide a certain number. Let's say in a lot of the whitelisted pools, the protocol can provide just 1 million worth of BNT to support the other side of liquidity provision, and anything above that will need BNT holders to come in and provide the other side of the pool. So these are sort of natural constraints on the system that allow the DAO to manage risk. So that's a sort of natural a constraint to consider. Mark, do you want to add?
Yeah, so I just wanted to, just as a note, it's kind of a misnomer to say that we don't trade against Ethereum on Bancor, because all of the assets are connected via the Bancor token. So we still have Ethereum on there. It's just that the base token is Bancor. But certainly we aren't thinking about transitioning to using a different base token. And there's a number of reasons for that. One is that if you think about the model that we've presented, in terms of its ability to offer impermanent loss insurance and support single token staking, this requires that the protocol has a token that it can change the supply of. If we were using Ethereum, you would never have that flexibility because Ethereum's tokenomics weren't developed for AMMs. They were developed for, for the consensus mechanism and paying gas. So no, we won't be moving to an Ethereum base. However, we are considering opening up a product that will allow people to provide liquidity, to bootstrap their liquidity pools by providing Ethereum as a protected collateral. So basically, if you provide Ethereum and whatever token that you're trying to contribute to the network, the protocol will mint BNT equal to the Ethereum collateral and bootstrap that pool, and your Ethereum deposit will become an impermanent loss protected deposit in the Ethereum pool. So in terms of bottlenecking growth, I think you are right? There is this awkward bureaucracy at the DAO where we need to decide on what the minting limits are going to be and which pools we want to support. And so we have this other mechanism now that's going to allow for, from the user perspective, exactly the same type of liquidity provision that they enjoy at Uniswap and Sushiswap, in the sense that they provide Ethereum and the other token. But from the protocol side, How the protocol uses that Ethereum is slightly different because it will go into the Ethereum liquidity pool and be used to offset the minting cost of the BNT, and then only provide one-sided impermanent loss insurance on the Ethereum and not the token side. So it's the sort of thing that we are thinking about. We do have ways of rapidly diminishing the bottleneck as you see it, but I do want to point out that if it was a bottleneck to growth, it would be hard to explain our rise to $1.4 billion in liquidity since October. So it's not a huge bottleneck, but we concede that it's not the most efficient.
And I think we're at an interesting phase with AMM protocols, where these protocols are really having to face down the reality and the predicament that supply side revenue does not equal protocol revenue. I think it was Sam from FTX that really called out how hilarious it is that Uni and Sushi are being valued when you look at their sort of price to sales ratio. They're being valued in terms of their sales by how much they pay to their supply, their market makers. And he said, I think it was in a tweet, that if an exchange were to raise money and try to suggest that its price over sales was its market cap against how much it pays to its market makers, investors would laugh that exchange out of the room. You don't value companies by how much you pay to the supply. You don't value Uber by how much you pay. It necessarily pays to its drivers. You value it by how much the earnings the company is making. And if you zoom out and look at, okay, so Sushi, has this innovative way. It pays its token holders, its Sushi holders, collect roughly 16% of total cumulative swap fees. Uniswap notoriously pays 0% currently to its uni holders. And if you look at Bancor, then you sort of scratch your head, because we are paying 50% of protocol revenue ends up going to, 50% of cumulative swap fees ends up getting paid and earned by the protocol. And that includes both burned BNT, that is earned by all BNT holders, regardless of whether you stake, and also BNT holders who provide that liquidity to the pool. So since the beginning of Bancor, we've had this design principle that there shouldn't be this massive separation between your supply and your owners of the protocol, the token holders. Because once you try to divert some of the revenue that the supply side is making to the token holders, the supply side will get upset and just leave, because you're dipping into their pockets. And so, we think Uni is a very interesting spot. You're not only subjecting the supply siders to impermanent loss, they're having to lose their long position on their token, but then once you turn on this mystical switch to divert some of the swap fees to uni holders, who, if you think about it, uni holders don't play any role or utility in supporting the system. They don't provide liquidity, they don't take any risk. And then if you start telling Uniswap LPs, well, no, now you have to give up some of your hard-earned revenue to the token holders, the so-called owners of the protocol, we think they're in a pretty tight spot there. And this is why we think it's so important, or we think it's this sort of sensible design to use the protocol token in each of the pairs. And that's really the sort of thesis behind Bancor's design.
Now, before we continue, I'd like to take a moment to share some exciting companies that made this podcast possible. With our sponsor, Crypto.com's mobile app, you can farm and trade DeFi coins such as DAI, Compound, YFI, and a lot more. What's more, if you provide liquidity, you can even boost your yield by up to 20x and harvest the daily yield in as little as 30 days. Their DeFi Earn feature also allows you to earn interest on your crypto with no minimum lockup period as well. So download the Crypto.com DeFi wallet app in the show notes below. One of my absolute favorite products in crypto is Aave. Aave is a non-custodial liquidity protocol, meaning you can earn interest on your crypto or borrow crypto assets without trusting any centralized counterparty to hold your funds. I personally have been using Aave for a long time to earn up to 12% of my USD holdings, like USDC, USDT, or even decentralized stablecoins like DAI, or exchange stablecoins like Binance USD, which totally blows my bank out the water. And if you're new to crypto and worried about security, Aave has been audited by security firms 13 times in 2020 alone, and once already this year, which they disclose fully. So I'm really excited to have a product that I love as a sponsor, so go on over to aave.com, aave.com, to check out which of the assets you'd like to borrow and lend today. How do you think about the value of the BNT token, right? Because as you said, so for Uniswap, I think a lot of the value is probably driven by the expectation of some sort of fee share, which already has been implemented by Sushi. As you mentioned, you can basically stake your Sushi tokens and be paid out in fees that are denominated in Sushi tokens. So you can, traditional finance analysts or investors can easily build some sort of a discounted cash flow model and very easily back out just how much revenue they're actually getting as token holders. Now for BNT, I kind of struggle a little bit more with kind of modeling the actual value of the token, given that there is the inflation in supply, but there's also that net burn in supply. So how do you reason about, how does one think about the token for BNT? Is it akin to equity if Bancor were a company, or is it more like a currency that powers the Bancor ecosystem? What is the framework that you use here?
Mark, do you want to take that?
Yeah, for sure. So I think that the best way to think about it is as a utility token, not as an equity share. So the way that you would value this is basically to, if we were to try and value the token right now, you can consider it as being a yield earning asset that is contingent on trading activity on the Bancor network. And so, there's a speculative element to this because we're still trying to develop and understand why our volume share is lower than it should be. But once we've addressed that, we're basically looking at if the total DEX liquidity share of Bancor is proportional to its total volume share in DeFi. Then you can actually compute how many trades, right, are going to go through the protocol, and therefore how much value, like what is the actual cash velocity through that system, and then how much of the value capture from pool fees ends up being distributed in BNT. So I think that's still the best way to look at it. It's it's kind of weird to be discussing transformative or disruptive processes in DeFi, which is itself a highly disruptive, product. But that is what we're doing, right? We're disrupting the system where the actual fees that you accumulate are going to be in BNT, and you can value BNT by how much volume is going through Bancor. And as volume drops off, the price should drop off, right? It doesn't have to be entirely speculative. It should actually be pegged to the profitability of BNT.
I think the easiest way, just to back it up, it's just like you would value Sushi at roughly 16% of cumulative swap fees or swap revenue. You can value Bancor at it would be valued at roughly 50% of cumulative swap fee revenue minus the cost of impermanent loss compensation. And so those are all metrics that some of them are exposed on our dashboard, others are in our Dune. Since it's so nuanced, these are making its way into the token terminals of the world and the dashboards of some of our strategic investors that are sort of doing this analysis on their own. but it is a bit of a learning curve. It's not as simple. There is a sort of beauty of how sort of simple it is to just value sushi based off of that. But the real nuance is the 50% of swap fee revenue minus impermanent loss compensation.
I should add here as well that we're currently working on some you know some plugins, for example, on June that will help to better explain the token supply. Because right now, like for example, if you go into CoinGecko, it looks like the 100% of the BNT supply is quote unquote in circulation, which is still technically true, but it would require someone to basically buy all of those BNTs from the liquidity pools in order to actually circulate them in any meaningful sense, which would actually drive the price of BNT to infinity, right? Because of the hyperbolic nature of AMMs. So there is a lot of BNT that's treated as being a part of the circulating supply that is for which there is no helpful vocabulary to describe what it actually is. And so we are looking at how some other protocols have dealt with this, and we are looking to improve how we communicate the metrics surrounding the supply side of the token. And I think that's going to help a lot with evaluating it.
Absolutely. Well, this has been a really interesting explanation, and I think it really gives a deep look into how it actually works. And I'd love to tie this into actual numbers, just to contextualize for our listeners a little bit better. And if there are no kind of actual numbers readily available, I'd love to understand what are the variables that go into these numbers as well, so we can reason about it easier. So, in terms of the supply of BNT, can you share any color about how fast is the supply expanding right now? Or kind of what kind of metrics are you tracking there to see how fast it grows?
Yeah. So as Nate pointed out earlier, the main token supply inflation, or really almost the entire token supply inflation, comes from our liquidity mining program. The IL inflation at this point, and also the slight leakiness that we get from the pools due to co-investment, those are basically negligible influences compared to liquidity mining. And so for liquidity mining, I think we're shooting for about a 40% increase in the circulating supply. And this is based on similar liquidity mining projects, such as the one, I think that ours is modeled very, very closely on the one that Synthetics used. And so that's basically the number that we're looking for. So you take the original supply, which was about 69 million, add about half of that, and that is a pretty good estimate for what the total inflation on BNT actually is at the conclusion of the liquidity mining phase.
And that's over a year or
18 months.
18 months. Got it.
And again, Jason, where it becomes hard is what Mark was saying before, is that a lot of supply is being minted directly into the pools where it exists until it is eventually burned. And that supply that's minted and stays within our pools is being considered by most of the mainstream analytic services as circulating supply. So some people look at our supply and think, oh, okay, that's quite a large jump, without realizing that a lot of that is eventually being burned as LPs withdraw and the fees are being generated by the protocol invested revenue accumulate.
That actually ties into my next question as well, which is at what sort of volume level do you expect to see supply start to contract? Like how much volume does Bancor have to generate in trade in terms of user trading before we start to see the BNT supply actually contract?
Well, I'd love Mark to answer this, and also Mark, you might want to tie in some of the nuances of Vortex to if that makes sense, to kind of help people understand how the contraction starts to occur.
Yeah, sure. So I think based on what we would really like to see is what Uniswap has achieved for some of its most performant pools, and we're confident that we can get there. But rather than talk about volume as an absolute number, because as we've pointed out, the supply is dynamic, it's actually more helpful to talk about the APY because this is applied to the BNT co-investment side and is a part of the deflation. So I hope you don't mind if I use this metric. But basically, anything north of 15% APY, and we've got targets that are slightly higher than that, up to and including 30% on some pools. That is when the overall liability of the protocol is starting to approximate zero or go negative, which means that the token supply is starting to contract. So when you come to our data page and you see that those APYs are starting to get consistently above 15%, that's when you can be confident that the token supply is either stable or starting to become deflationary. As Nate pointed out, we have this other mechanism which is also going to allow the token supply to virtually contract, which basically is derived from the fact that when a BNT holder deposits their BNT into the protocol, it generates a VBNT token, and that VBNT token is usually used for governance. But just recently, we introduced a new feature that uses VBNT as more of a derivative asset of BNT and allows you to take a debt position of sorts. And so on the VBNT BNT pool, you can trade those VBNT tokens for anything that you want, like WBTC, Link, ETH, whatever it is that you want to do with it. But as you trade out those VBNT tokens, you are no longer able to withdraw the BNT stake. So if you ever wanted to withdraw that BNT stake, you're going to have to reverse that process, buy back the VBNT, and then burn those VBNTs to withdraw the underlying BNT. So what the Vortex does is it uses this pool and it diverts a very small percentage of swap revenue. So this doesn't eat into LP's deposited capital. It's taken just from their profits, and those profits are then used to buy VBNT off that pool and then burn the VBNT. And so what this creates is actually a positive feedback loop where as people sell their VBNT and enter into leveraged positions, they may have to come back and buy that VBNT at a slightly higher price, or be forced to buy BNT from the open market and then stake it to generate VBNT sufficient to unlock their older stake. What this creates is a situation where BNT continues to become locked up over time. And as the Vortex continues to burn VBNT from the pool, it means that the amount of BNT that can be withdrawn from the protocol, it gets reduced over time. And this is important for us, right? Because the BNT that's locked up in the protocol isn't being swing traded, so it doesn't contribute to pump and dump behavior. It's also in the protocol where it's supporting single-sided token deposits, and it's also accruing fees. And as long as it continues to accrue fees where no one is coming back to claim it, that actually becomes a part of the virtual burned token supply. One of the conversations that I often have with people about Bancor tokenomics is that burning tokens is not necessarily the best way to do things, right? If you've got a utility token that's yield bearing, burning it is probably one of the worst things that you can do with it, right? Contracting the supply and driving scarcity is not necessarily the best way to create value. There are much simpler ways that you can drive a scarce asset, but that doesn't necessarily mean it's becoming more valuable. And the same is also true in reverse. You can inflate the supply of something and have it become much more valuable as long as the utility is increasing over time. And so at the beginning of the V2.1 launch, it was pretty clear that there weren't enough BNT in existence to achieve what we wanted to achieve. And so inflating the supply was a very healthy way to go about expanding the business and making the protocol achieve what we wanted it to. So yeah, in short, there are going to be these contraction phases that the protocol goes through. And it's going to involve people withdrawing liquidity from the token side, which allows the protocol to burn its co-invested BNTs. There's going to be deflation from users entering into leveraged positions that they can't get out of very efficiently. And there's going to be deflation from just the stakes in the protocol from accumulating BNT over time. So there are these effects, but they are deflationary in the sense that they keep BNT off the market, but the actual supply that you see on CoinGecko won't change. So it is a really difficult thing to compute in the same way that a lot of projects in DeFi are currently treated. But that's okay. I think people are warming up to these ideas, and the people that have spent the time studying it, I think, see the value in what we're trying to do.
Let me try to Li5 that because Mark is kind of too smart for his own good. Vortex is kind of like a native lending engine built into an AMM protocol on Crack, and the burning. So we're in the first phase of Vortex, where it's been approved by the DAO, and very soon a portion of swap fees from users who provide the token side, not the BNT side, will start being collected in a public wallet. And effectively with Vortex, anyone can borrow against their staked BNT. So provide BNT to the pool, get VBNT, which is essentially your pool token, and then convert that to any token and do whatever you want with it.
So you get 1x leverage, basically.
What was that?
You get 1x leverage.
Yeah, it is 1x leverage. That's exactly right.
And effectively what we're doing with the burning mechanism is we're starting to charge a small fee to token liquidity providers for impermanent loss insurance. We've seen this massive demand for impermanent loss protection. Every time there's space in one of these pools, it gets immediately filled up by token liquidity providers to get access to this. So we're starting to charge a little fee that is then getting burned for VBNT, and as Mark alluded to, is sort of this further deflationary mechanism. That's sort of my attempt at kind of simplifying it. I know there's a lot in there, Jason. Did that make sense?
Yeah, that makes total sense to me. And it sounds like you guys are able to create this kind of almost native IL insurance that isn't a separate product, right? So basically it comes with your liquidity provision. And as part of that, you're also able to levy a fee, which goes to burn part of the BNT supply over time. Is that roughly correct?
Yeah, it's spot on.
And I also love to understand this kind of IL protection because it's such a huge part of the discussion today. And I know a lot of a lot of listeners may be confused about how IL actually impacts them because, sometimes people deposit their assets into a pool and they see that they lost value. They're not sure how much of that came from the drawdown in price of the assets they deposited versus how much of that came from IL. So I'd love to kind of just, maybe put this in an example. Say I have $50 worth of ETH and I put into this pool, which also has $50 worth of BNT supplied by the protocol. So $100 worth of BNT and ETH in this pool right now. So next day, let's say, God forbid, but a hack happens and BNT drops like 50% in value. How much do I actually have now? And how much do how am I protected from impermanent loss?
Sure. So the drop in BNT value would mean that the protocol would essentially start selling the ETH in this example. And this is not the protocol actively doing it. It's a passive thing because there are going to be market opportunists who we call arbitrageurs, right? Who are going to see that the BNT price has dropped on external markets, but according to the bonding curve inside the pool, until someone trades against it, the price is whatever it started at. And so in order to move the price down to meet the market expectation, an arbitrageur can buy the cheap BNT from the market, like Binance, and then sell it on the pool at a slightly higher price. and this is going to start forcing the price down according to the bonding curve. So when they're selling that BNT on the bonding curve, they are extracting Ethereum at the same time. So in the case that you've provided here, where the price of BNT drops by 50%, the actual effect on the Ethereum supply isn't huge. I don't have a spreadsheet up in front of me right now, but it's going to be massively selling off Ethereum. So what happens is, when you try to withdraw that Ethereum, the protocol will see that you don't quite have the Ethereum that you started with, that you should be entitled to under the impermanent loss protection. So what the protocol will do is mint a little bit more BNT and offset the difference in Ethereum that it then allows you to withdraw, effectively by kind of swapping it with the pool. That's kind of it's a little bit more complicated than that, but that's essentially how that works. So on something like Uniswap or Sushiswap, there is no one paying attention to the losses that the liquidity providers are taking. So we were using BNT and Ethereum in this case. So let's consider a situation where we've got Uniswap tokens and Ethereum on the Uniswap pool. If there was a token hack on the Uniswap token and someone minted double supply or something and the price crashed, the exact same thing would happen. An arbitrageur would immediately start selling Uniswap tokens on your Ethereum pool and extract the Ethereum from you. Except that on Uniswap, when you withdraw, you're going to find that you've got a lot less Ethereum than you started with, and a lot more Uniswap tokens. But the overall value is going to be less than you expected, and that's where the impermanent loss starts to come into it.
And let me try again. LI5 for impermanent loss. Put in two tokens, and I'm talking about the traditional AMM, the Uniswap and the Sushiswap of the world. Let's say I put in Uni and ETH into Uniswap. As the Uniswap's price is rising, as a liquidity provider, I'm selling off my Uniswap, and as the Uniswap and acquiring the ETH, as Uniswap's price is falling, as a LP holder, I'm selling off my ETH and acquiring a Uni. So the bet up until now that liquidity providers have been forced to make is the hope that the IL, which is inevitable, but is more aggressive when there's higher price divergence between the risk asset and the paired asset. But the bet that they've been trying to make is that the fees generated and liquidity mining rewards on the pool, if they exist, will be greater than the impermanent loss. With Bancor v2.1, you are always compensated if you're in the pool for a certain amount of time for and again, we should clarify that you have to be in the pool for 100 days or more for 100% protection against impermanent loss. If you're in the pool for more than 30 days, it's 30%, and then it increases by 1% per day. So we really encourage this sort of long-term LP behavior. But with Bancor, you can be sure that you're always going to be compensated for impermanent loss, and that the fees and mining rewards that you accumulate are just on top of that. So they're pure profit. Whereas before, the fees and mining rewards that you get in a standard pool are really getting eaten into by your IL, and you're hoping that the IL is not greater than the fee revenue and mining rewards revenue. And so we've had LPs show up, and we have these really cool tools in our portfolio manager. If you go to bancor.network and you open up a position in a pool, you can track and you can see how much your initial stake is. You can see how much IL it has suffered. You can see how much your protected stake is based off of the amount of impermanent loss insurance that you've accrued. So you have all this visibility into these metrics, and you can know for sure that if you're in the pool for 100 days or more, any IL that happened in the first 100 days or any time thereafter is covered. And again, your fees and minor rewards are pure profit. Now, this stands really in stark contrast to a protocol like Uni or Sushi, where you go into the front ends and you see an APY figure. And we think these APY figures are pretty misleading, actually, because they are saying 100% APY or 70% or sometimes lower, often lower. But this is not taking impermanent loss into account. What you end up pulling out can be vastly lower than what's quoted and can also be negative, can be below zero. So we hope that as LPs learn about IL, get a taste of a new model, they'll start demanding more transparency from these AMM protocols, and not, not accepting that you can just post APY figures without taking the IL into consideration, or protect against IL. Then the APY figures will, in my opinion, be less misleading.
Absolutely. Well, this has been a really enlightening conversation, and there's so many different moving pieces that I want to make sure our listeners take away with a correct synthesis. So, just let me attempt to kind of summarize what we've discussed, and you guys can let me know if I'm wrong. But it sounds like for a lot of market makers or liquidity providers to these existing popular AMM protocols out there, like Uniswap and Sushiswap, they're exposing themselves oftentimes to this problem of impermanent loss, where they are expressing a de facto short volatility view that they don't really mean to express, and they may lose some money if the asset prices in the pool that they provided their assets to move in one way or another. And then you guys have come up with this model that manages to mitigate a lot of the risk, perhaps at the short term expense of the BNT token, which may inflate its supply. But the hope is that in the long term, this will actually draw in enough liquidity that generates enough trading volume that the fees will actually overtake this increase in supply and actually becomes contractions in supply. Is that roughly the right way to synthesize the whole conversation? I know there are a lot of points to cover there, so I must have missed a lot of things.
So
Yeah,
I think it's pretty much on point. The only thing I'll note is that the compensation for impermanent loss has been very, very minimal up until now. The inflation that we've seen in the token is, as Mark said, is largely a result of liquidity mining rewards. So I think the only point I take issue with is that it's at this sort of short-term inflation, and that we hope over the long term that that will come down. But that's really not tied to IL. I think the IL risk is, we have a paper that just came out, or that came out recently, that showed that the compensation that we're paying out is quite minimal, because we've been able to cover it with fees generated by the protocol. And so that I guess the only part I'd add is that it's not just this sort of short term cost and hope of a sort of long term deflation. It's more so that this sort of the short term inflation is largely liquidity mining rewards, which, by the way, and sorry to even complicate this picture even more, but we're seeing that because these pools are single-sided, you provide single-sided liquidity, we're not seeing the type of farm and dump behavior that you'll typically see from yield farming, liquidity mining programs. Typically, once I get rewards as an LP, if I want to restake that to the protocol and compound my yield, I'll have to do one of two things. I'll have to either sell off half of it. Let's say I get rewards in sushi, and I want to provide that sushi back to the sushi ETH pool. I'll have to sell half the sushi for ETH and put the other sushi on the other side. Or I'll have to take the sushi reward and pair it with some of my own ETH, and again, put all these tokens on the line for IL risk. Now, what we've seen, which is really cool with single-sided pools, is we've seen about 80% of BNT that is rewarded to LPs get restaked back to the protocol, because the liquidity providers who receive it don't have to add any more tokens, or don't have to split and sell off half the BNT in order to sort of restake it to the protocol. So it creates this very cool sort of liquidity positive feedback loop where you're rewarding and then those rewards are being restaked. And this can also be replicated for the token side. We're coming out with joint liquidity mining, where a project can offer liquidity mining in their token. And just like the BNT that's being provided to both the token side and the BNT side, the token rewards can also be restaked single-sided without selling off any of these tokens. And this will encourage projects to provide liquidity mining rewards because it's not this guarantee that people are just going to earn the reward and dump it. So that's sort of a qualifier there, but I think you've done a pretty great job of summing it up.
Yeah, that's fascinating. Thank you so much for that. And I guess just to close this off, just to kind of help the listeners think through this model a little bit, what would you guys say are some major trade-offs that you have made in designing the Bancor network this way?
Gas fees.
Mm.
Yeah, right. So the complexity of our contracts is pretty high, because it's necessary, right? Because we need to keep track of specific user deposits. It's important to realize that impermanent loss is a personal thing, right? It's not, you can't just say that the impermanent loss on a pool is X. You can say maybe on average, but actually every single deposit, every single time someone interacted with the contract to deposit liquidity to the pool, has its own unique impermanent loss that needs to be tracked and kept accurate so that we know how much to compensate them should they experience IL at the end of their stay. So yeah, the contracts are quite complex, and we have, it's no secret that a swap on Bancor is slightly more gas heavy than some of our competitors. But we are moving towards a massive protocol-wide upgrade that's going to simplify the way that some of these things are handled. And that should start to address the gas costs there as well. I should also point out that we are partnered with Arbitrum. We collaborate with them regularly, and we've launched Bancor on their testnet to see if the contracts work there, and everything seems fine. And that was about I think a 40x reduction in gas fees on layer 2. So the gas fees thing is certainly one of the trade-offs that we've had to make, because we've built a more complex product and there's more computation required in order to make it operate. Nate, did you have anything to add to that?
Yeah, so a trade-off for me that we have a solution coming to, and that I'm particularly excited about, and you alluded to, is that with V2.1, because we're covering the potential cost of impermanent loss insurance, it's really most suitable at this stage, the whitelisting of tokens for V2.1 for sort of the mid and larger cap tokens. Now, Bancor is completely permissionless in terms of listing. Anyone can create a pool with any token. It's just, it will be that sort of V1 a pool that's not protected against impermanent loss and doesn't have single-sided exposure. Then once the DAO whitelists it, it gives it those features. And so a lot of people have said, okay, Bancor has this interesting model, and it looks like, the tokens will do, these new DeFi tokens will launch their sort of initial pools on like Uniswap and Sushiswap, and then once they graduate to being able to get whitelisted by the DAO because they're maybe a little less volatile, there's more trading volume, and they can produce more revenue for the DAO, at that point they'll sort of graduate to this to this level. And so that is a current trade-off, but I will say that the long tail of assets, these new tokens, is really in the DNA of Bancor, and we're not ready or willing or plan to concede these sort of early stage DeFi hot tokens to launch their first pools on Sushi or Uni. It's a huge amount of volume that they generate there. There's a lot of trading activity that can be generated there. And so that's what Mark alluded to earlier, that we will be offering pretty soon a really interesting token onboarding mechanism that allows pools to be started on Bancor with ETH as the paired asset. And the ETH side of the pool from the get go will be protected against impermanent loss. The token side won't be protected. And then gradually over time, it will get sort of onboarded and provided more IL insurance by the DAO and more capacity for single-sided liquidity provision. So we can really capture the full life cycle of a token from its earliest beginnings up until it becomes that mature revenue-generating token that's more suitable for whitelisting in the DAO. Does that make sense?
That makes total sense. Thank you so much for that detailed breakdown. And for people who want to learn more about Bancor, because there's definitely a lot more to dig into, what would you say are the best channels for them to get started, especially for people who want to really understand the token economic side of things that we discussed?
Yeah, sure. So we have a sort of wiki that we've started to expand, and that's in the resources section of our docs. So that's docs.bancor.network. Our blog is where we constantly provide updates. So blog.bancor.network. And then we're super active on both Telegram and Discord and very welcoming. So anyone who wants to come in and ask questions, we love sort of jamming on the tokenomics of the protocol. And Jason, before you let us go, I'm going to have to hold you to something because I'm always super curious. People that have really good views and these 30,000 foot views of the industry. I'm very curious. I brought up earlier in the discussion, what's going to happen when some of these protocols try to divert some of their supply side revenue to token holders. So as we're seeing these astronomical valuations, which in some ways I think are sort of justified. I do think AMM protocols will be the sort of NASDAQs of the future. But I'm very curious to see once Sushi and Uni in particular try to divert some of the supply side revenue from the pockets of liquidity providers to Uni holders or Sushi holders. I'm very curious, how do you think that those ecosystems are going to react? And in particular, the liquidity providers who are having to pay some of their APY to token holders. How do you see that sort of playing out? And I know a lot of this is speculation and we don't know. But I'd be curious to hear your take on that if we can sort of discuss that for a
Yeah,
second.
yeah, happy to offer my quick take there. I think just zooming out even more, I think the aggregators will eventually take all the liquidity because they, from a user experience perspective, I think they're superior to needing to kind of go to different pools and splitting your orders between different pools. And I've moved a lot of my personal trading volume to aggregators as well. So to me, the winning DEX will be the one that captures all this flow from aggregators. So meaning they capture most of the volume, and to capture most of the volume, you need to be offering the best prices. And to offer the best prices, you need to provide the most liquidity. And so it really comes down to, I think, where there. So it's a little bit of a chicken and egg because if there's no volumes on there, then it doesn't matter how much of the liquidity provider's revenue you siphon off to token holders or siphon off to the protocol, the LPs wouldn't want to be on the protocol because there's no volumes there. But then if you siphon too much of the revenue away from liquidity providers, maybe they don't want to be there in the first place. So to me, it's more of an open question, but I see where you're coming from. I do think that if you start to take away revenue from some of the liquidity providers, then it reduces the incentive for them to stay on the existing platforms. So I think for the purposes of time, I think my final view that I offer here is that this is probably the most exciting time to be in DeFi. The volumes we've seen is unprecedented compared to last cycle, and the innovation that we have seen, especially in the case of Bancor, what you guys are doing is truly groundbreaking, and I'm really excited for what you guys are working on. So I'm really glad to be a part of this space right now.
Likewise, well, I'm pretty grateful every day to be in it too. And yeah, and thanks so much for your time and for your views. I think that's an interesting view that you presented there.
Absolutely. Thank you so much, guys, for taking so much time to explain all of this for us. I'm sure our listeners will thank you a lot. Thank you.
Thank you.
Thanks, Jason. Take care.